Hey everybody, welcome back to the channel. So the market is at all-time high, and thought I would discuss a topic about valuation actually, and I think it's a bit fitting given that the market is at an all-time high. The particular valuation metric that I want to talk about today is called the price to sales ratio. So on the screen, I have the price to sale ratios of a few companies. I have Facebook, Visa, and Microsoft. Initially, I didn't like the price to sales ratio because it didn't really tell me much. I mean, if I earned $1 in revenue, but if my profit margin was 10%, I mean, I'm really earning just 10 cents, right? Not the dollar. So something like maybe cash flow or earnings would have been a better valuation metric, I thought, but I'm going to like price to sales ratio. I think the way to look at it is really to look at it in terms of the operating margin, which is why I have operating margin of these same companies here as well. I think price to sales ratio is good for companies that are not yet profitable. There's one company called Shopify, which I'll talk about later, which is not profitable, and so perhaps the price to sales ratio is a good valuation metric to use for that. The other thing good about price to sales ratio is that it talks about revenue, and revenue can't be manipulated. Earnings can be manipulated because there's all sorts of accounting tricks that can go into making your earnings look better than what it really is, and even cash flow to an extent sometimes, because there's so much capex expenditure, it can deflate cash flow, and that might make it seem like the business not generating much cash when it's just a momentary hiccup. So revenue can't be manipulated that much. So in that sense, the price to sales ratio is quite transparent. So the way I look at it is, I roughly take the operating margin of the company, say Visa here, which is about 62%, quite amazing operating margin, one of the highest actually, and I divide it by a quarter actually to get a reasonable price to sales ratio, and I just use this as a rule of thumb. And I mean, for these companies, I assume there's a revenue growth of 10% and above, and I usually only invest in companies which have at least some revenue growth. So if you take Visa for example, 62 divided by 4 will give you about 15.5, and you can see that Visa is about 18, so maybe it's a bit overvalued compared to the price to sales ratio we like to buy it at. And if you look at Facebook has operating margin now of about 38%. If you divide it by 4, you get about 9.5, which is a bit higher perhaps, but it's around the ballpark. And similarly for Microsoft, 33, you divide by 4, you get about 8.25. So you see, it generally comes in handy as a rule of thumb if you divide the operating margin by 4, and then you get a reasonable price to sales ratio. So the reason why I'm looking at price to sales ratio is also because I'm very interested in this company called Shopify. Shopify basically, it's one of those companies that has been growing at an amazing rate. And you can see here from the chart, it's grown over the last 4 years, almost 1,000+% compared to the Nasdaq, which is about 66%. I haven't been able to pull the trigger on Shopify. To be fair, I only got to know Shopify in depth about a year plus ago, and I really got to understand its mode a bit better. And if you're interested in me doing a deeper dive into Shopify and why I like it, maybe put it in the comments, and then I'll consider doing a video about Shopify. But coming back to the valuation metric, so I'm generally okay with buying companies at a reasonable valuation. It doesn't need to be even a fair valuation, but something reasonable. But I'm having a hard time pulling the trigger on Shopify. And I wanted to do this case study on Facebook against Shopify, so I could help myself and help you understand why I'm having such a difficult time deciding to buy into Shopify right now. So you can see right now that Shopify has a sales price to sales ratio about 29, Facebook has about 9. That's okay. I mean, Shopify is growing at a much higher revenue growth, as 49%, almost 50% compared to Facebook. And I know Shopify has negative operating margin, meaning is losing money. But the case again, the bull case for Shopify at least seems to be that it's losing money now, so that it will be able to gain a lot more operating leverage later on in its life. And so I'm taking the rough case of operating margins being around 20-30% maybe in a few years time for Shopify, provided it does retain its moat and it does retain its leadership position in the e-commerce space. But I still have a hard time buying Shopify. And if you look at this particular point in time in June 2016, right? And I've even done a screenshot of that right here. So you can see that Facebook was also growing at about 60% at that time. And at that time it had a price to sales ratio about 14 or 15, even 16 maybe, right? And it was still making money even at that time. But Shopify is not making money. I mean, it has a lower growth rate than what Facebook had in June, and it's trading at a much higher price to sales ratio. So this makes it very difficult for me to invest in a company like Shopify at this particular point of time. So let's see. I mean, hopefully Shopify becomes a bit more attractive. If the price comes down. So just thought I'd do an update about the real money portfolio as well. The market has been booming, and the real money portfolio is almost near its all-time high. It's crossed 150,000, so I'm quite pleased about that. I'll do a full update when the time comes in July, and then we'll look at some of the monthly comparisons as well. So I hope you enjoyed this short video about the price to sales ratio. Please like and subscribe, and I look forward to any ideas you have on videos you'd like to see as well. Have a great day.